Joining me is Lincoln Ellis, Managing Director at Lind Group, Matt Shapiro, President of MWS Capital, and CNBC contributor Don Luskin of Trend Macro and proud author of the brand new book, I Am John Galt. All right, John Galt, let me start with you. From a stock market perspective, we're going to look at it from the Fed side in the next segment. Why did the market do so well as the Fed slams the door on QE3?
Well, Ben Bernanke, who brilliantly has made himself the new maestro by doing these press conferences, basically telegraphed that very explicitly right after the last FOMC meeting. In response to a question, he said just very right out there won't be any QE3 because the risk-reward ratio ain't there anymore. Unemployment's coming down a little bit, inflation's going up, those are both things they want, so there's just no point in doing it anymore. That's really old news. The good news in these minutes is that it completely confirms it, so stocks celebrated.
Stocks celebrated, Lincoln Ellis. Do you buy the celebration? Back to oil, back to energy, back to the big economic growth sensitive stocks like materials and industrials. Do you buy that, Lincoln?
Absolutely not, Larry. As I said a week ago, we were stepping aside, and a week ago, things actually moved south anywhere between 3 and 5%. So for us, the lights are still very much flashing yellow. I'm not sure what part of slowdown this market doesn't get. If it wants to celebrate the end of QE2, the celebration will be short-lived. There's slowdowns in China, in the emerging markets, in Australia. In the UK today, we saw very weak data, and our own ISM, Empire State, and Philly Fed last week were absolutely horrible. So we continue to be very concerned. I think today was a dead cat bounce. King dollar moves to Prince dollar, and we're very concerned here.
Yes, indeed. Prince dollar does rise. Matt Shapiro, after a day like today, after hearing the Fed minutes, after seeing oil prices rise this morning on lower than expected inventories, how are you investing? Be specific for us so our viewers can take some action.
Well, we had a big buy on the dips chance, but it evaporates so quickly. Some of my big blue chips, UPS, Boeing, Disney, which had a disappointing earnings report. I mean, these are all big companies paying great dividends. And I think the big news about the Fed today was that, remember, I think the Fed's going to lift rates by the end of the year, and the market actually took it in stride and went higher.
Well, now, if the Fed lifts rates before the end of the year, that's an interesting position. You are a contrarian, probably a sound contrarian. How do you invest on the strength of that thought?
Well, that's going to be good for the economy because it's going to show actual credit demand. And I think the fear in the long end of the bond market is going to be misplaced because I think it's going to take out a lot of that inflation risk that some of the bond doomsayers have to offer.
Don Luskin, if the Fed does what Matt Shapiro said, they're going to end QE2, no QE3, maybe some rate snugging before the end of the year. I want to ask you something. Might that be really a shot in the arm for the economy and stocks? Might that, QE2, the economy kind of slumped. Maybe QE nothing with some Fed snugging and a stronger dollar will give us something like an economic boon. I've read Joseph Calhoun on this subject. Where does Don Luskin and then John Galt come out on this? Maybe it's the best possible thing.
Well, John Galt's in Galt's Gulch. We can't ask him. I'm on my own on this one, Larry. I think that if the Fed were to raise rates at this point, it would be too soon. I think it would be a big mistake. It would be pulling the rug out from under an economy that's doing okay, but okay at best, unfortunately. However, let's say we do end up in a world where by November or December the Fed is raising rates. Why would it be doing that? It would be doing that because the unemployment rate has come down, because inflation has continued to go up, which in my book are two good things. And so rates going up wouldn't cause the economy to do better, but an economy that was doing better would cause rates to go up. So I hope rates go up because the only circumstance under which they will is if the economy does better.
All right, I'm going to get your investment. I'm going to get your investment picks in a minute. Get ready. But Lincoln Ellis, I want to ask you one thought before I get your investment picks. Some of the budget talks in Washington, D.C. have broken down. Senator Tom Coburn left the so-called Gang of Six, which was a bipartisan group trying to parse things through. That looks dead. Does that affect your thinking? It didn't affect the stock market today, that's for sure. Does that affect your thinking?
No, absolutely not. I mean, look, Geithner and Bernanke are quite clear, as is the Obama administration, that they will continue to play shenanigans with the budget ceiling. They'll continue to try and play these games of chicken for political points. But the markets, in fact, are very sound. in terms of their ability to navigate games of politics over policy. And I think that, no, the budget, the debt ceiling issue actually gets taken care of and gets squared away. And unfortunately, it leaves wide open a summer where, as John pointed out, the pass-off of the baton between the public sector and the private sector is not yet ready. So get ready for a rough and tumble summer.
How much will the stock market fall in this rough and tumble summer in your scenario?
Well, look, we think that fair value on the S&P is around $12.75, and that prices in a forward earnings expectation that shows GDP growth at 2.5, 2.7, and global GDP growth down from 4.1 into the high 3.8s or something.
And what would you buy or sell?
I'm sorry, I have to ask a question. If you're forecasting GDP growth of 2.5%, and last quarter it was 1.8, why is that a slowdown? That sounds like a speed up.
In the second half, you will actually get sub 1% growth as you get massive amounts of budget cutting both at the state and federal level, and you're going to see a type of stress that the private sector will not simply be able to handle, and that will cause consumers to tuck in even further than they have at $100 or $110 oil, and you will see.
I'd love to see government get out of my way, boy. That's the kind of stress I could handle. Bring it on.
You know, Matt Shapiro, I got to say, if I thought the government was going to have massive budget cuts, I mean massive budget cuts, I would be jumping for joy, Matt. I'd be buying the store.
You're going to have an unemployment rate, Larry, that's going to go back north of 9 if that happens.
I don't know. I think if they do with that, let's say they cut the budget by a couple of $1 trillion, I say that opens the door with an unemployment rate of 7, not 9. And if they stabilize the dollar,
and not only that, the kinds of jobs that get created in that kind of environment are hamburger flipping jobs. They're not sustainable wage jobs. They're not jobs that produce any kind of consumption.
Well, at least they're not government.
But how do you
jobs.
like all those? How do you like all those jobs that were created with all the stimulus spending? It was all just government jobs. I'd rather flip hamburgers at McDonald's and work for the government.
Don Luskin, as you flip hamburgers at McDonald's, what are you buying and selling right now?
Well, I'm going to double down on the same bet I've been talking about for a couple months. I like the industrial sector, and the reason I say that is last year I was all about the consumer. I was all about saying, no, this whole new normal thing is just BS. It's not going to happen. Bet on the consumer. That turned out to be right. Consumption's at all-time highs. But the capital investment, that's what industrial companies are into, not consumption. That's the part of the economy that hasn't yet come all the way back. It's come halfway back, so it's still alive. So it's time to play that ascent from halfway up the recovery mountain to all the way up the recovery mountain. And John Deere's earnings and guidance this morning totally validate that.
All right, Matt.